Hello everyone and welcome to the Compak Asset Management YouTube update for October 9th, 2020. I'm Moe Ansari, President of Compak Asset Management, host of Market Wrap, and the Chief Investment Officer here. Don't forget to tune into my daily broadcast, the 1-hour broadcast, and you can download that broadcast or the app where the broadcast will be downloaded automatically to your device. All you have to do is click on the link below. Again, don't forget to subscribe to this link and to this update. Whenever I do an update, you will get notified if you're a subscriber. Click on the link below, or to share, just click on the share button below and you can share it with your coworkers and your friends if you would like them to get this update also. I'm going to talk about the U.S. markets, the economy, the elections, and don't forget, on Wednesday, on the 14th, I'm going to do a 2-hour webinar. I will also answer your questions, anything you want to know about the markets. I'll try to get to as many of those as I can. That's 2 hours where I will look at the markets, the economy, the elections, and the impact of all of these different things on the market. I'm also going to take a look at the technical analysis of the markets today. So that's a preview of the webinar. We're going to talk about the stimulus package. That was the big deal this past week. We had the stimulus package. Then on Tuesday, the president said no negotiations. Then on Thursday, he said, wait a minute, we are negotiating. And today he said, well, we'll put together a new package of $1.8 trillion. The Democrats have already passed a $2.2 trillion package. So will they agree? I think they will. We need to get more stimulus out to get the economy going. Currently, there is no agreement, but we are getting closer and closer to an agreement. Will it be done before the election? Will the money get out before the election? I think in the next few weeks, we are going to get it out, maybe before, maybe after the election, but we will get more money into the system, and that is going to be positive for the market. Again, we've done a tremendous amount. If you look at the loans that we have that have been handed out, you can see in Germany, we've got a tremendous amount of money that has been sent out as guaranteed loans. And then we have fiscal government spending also. You look at it around the world, everybody is just putting a tremendous amount of money into the system. Most of this money shows up in the stock market or the real estate market. As I've said repeatedly, since 2009, when the government did the first TAF program, the TAF program, and all of the different, it was only about 800 billion compared to trillions of dollars that is being done right now. We did 800 billion, and people were very upset at that time. And so many of you called me on the radio broadcast and said, Mo, this is going to cause inflation, it's going to devalue the dollar. And I said, look, the government is handing out money. You want to get your share first, and the way you get it is by participating in the stock market and the real estate market. That's where the asset prices are going to inflate. There will be issues, there will be problems somewhere down the road. Here we are 10 years later, we still are not seeing those problems. Maybe 10 or 20 years down the road, there will be issues with the debt. But at this point, we need to worry about what is now, and as the market changes, we can make the adjustments in the portfolio. You can see that we started out here and we dropped we were at 100%, this is pre-COVID, we dropped down here to 60%, but now we're down to back up to about 80% of where we were prior to COVID. We're still 20% lower. So now we've sort of stabilized. We came back off the bottom, and for the last 2 or 3 months, we're sort of stabilized, not going up or not going down. We need more stimulus from the government until we get to the other side of the pandemic. As I've said, this is not an economic problem, it's a medical problem. We don't solve the economic problem until we solve the medical problem first. If we try to reopen without having a vaccine, without having this under control, the virus is going to continue to expand. And if it does explode again, people will lock down themselves, not that the government will have to do it. Don't forget, we are doing the webinar next 6 p.m. next Wednesday on the 14th. Click on the link below if you'd like to register for that. It's a free webinar, no cost. I'll try to answer as many of your questions as I can. Let's take a look at the technicals. My favorite, the market came down to support, which is right around 3,200 for the S&P. Now, this was, remember last week we were looking at this and this looked like a 1, 2, 3, and I said this could turn into an ABC, and that's exactly what it has. It's an ABC now, and we're starting a new wave count to the upside, just like here. Wave 1, 2, 3, 4, 5. Once we get wave 5, then we get a correction. Now we're starting a new wave count to the upside, wave 1, 2, 3. The target is 3,600 on the upside. Then we have higher targets right here and right here. This is 3750, and then we could look at 4,000 for the S&P. Will it happen in the next quarter? I don't know, but long term, we're looking higher. If we look at the weekly target, again, we've started this new wave count on the weekly targets to the upside. Wave 1, 2, 3, fourth wave. We went through the pullback, got to about 3,200, 3,209, and now we're looking at 3,750 as the first target for the S&P on the weekly charts. Will we get there in the next 3 months to 6 months? It might take some time, but that is the weekly target now for the fifth wave or third wave extension. And then we can get another wave pullback, and then we can start the fifth wave. So this could be a third wave extension, or it could be the fifth wave. We'll have to wait and see how this looks on the charts as we continue to move. Nasdaq again looks like we're going to the fifth wave. 12,800 is the initial target, and then we've got some higher targets on the market. 12,000 is first resistance. That's the previous high that we made on September 2nd. If we can get off 12,074, 12,800 is the next target. These are the support areas on the downside that I'm looking at on the Nasdaq. On the weekly charts, one of the things that I talked about was the parabolics. When they get hit, usually we get a period of down move, but then once we get the up move, they usually last a long period of time. Well, again, we got the down move, we had the parabolics turn down, but now we've turned back up this week to the upside. This is the long-term upside target on the weekly charts on the Nasdaq, which is around 14,700. Now, there's a lot of short-term targets and all of that, and we can look at but again, as investors, we're looking at the long-term trends. We've just gone through a correction, got a pullback. That was the opportunity. If you missed and you got sold out of the market somewhere around here in March, unfortunately, and you're still sitting there waiting for the correction, that was it, what you just saw over the last few weeks. From here, I think the election people are starting to feel more comfortable. People are concerned if there was going to be a blue wave, as it is being called, or Democratic wave. If Biden wins, oh my God, what's going to happen? Taxes are going to go up and so on. Now the markets are starting to realize that if we do get a blue wave, it might be as bad. I'm going to talk a lot more about this at the webinar on the 14th, so make sure you tune into that. Weekly gold looks like 1850 was the low. We looked at the fourth wave pullback. Now we've got some targets, 2150 on the weeklies and then 2475 on the weeklies to the upside. One thing that I have been looking at is the interest rates on the 10-year note. They've been sort of hovering right around 0.5. This was the low that we made in March, which was 0.31. We've come back up. That means people are not as worried. People buy bonds when they're scared about the stock market. So now we're starting to see people get out of bonds, go back into the stock market. The risk on trade is coming back. Well, watch the yield on the bonds. If it gets below 0.5, that would not be good for the stock market. Yield going up is good for the stock market. That's the update for October 9th. Don't forget to tune in for the webinar on the 14th. That's next Wednesday. Thank you again for tuning in.